I am OG John, original. Good evening. In a convergence of economic signals that markets have not seen in years, three major developments landed simultaneously today. A jobs report pointing toward stagflation, crude oil breaking a 2-year high, and a deepening physical shortage of silver across multiple continents. The United States economy shed 92,000 jobs in February, a stark reversal from the forecast calling for a gain of 58,000 positions. Unemployment climbed to 4.4%, edging above the estimated 4.3%. At the same time, average hourly earnings continued rising at 4%. Jobs are disappearing while wages remain elevated, a combination economists identify as stagflation, simultaneous economic stagnation and persistent inflation pressure. In energy markets, Brent crude broke above $90 per barrel for the first time in 2 years, with West Texas Intermediate sitting at $87. Qatar's energy minister issued a warning that oil prices could reach $150 per barrel within 2 to 3 weeks, should tanker movement through the Strait of Hormuz be disrupted. Natural gas prices, under the same scenario, could rise by 400%. Meanwhile, silver vaults at the Shanghai Futures Exchange have lost 77% of their inventory since October, and are now tracking toward empty within 15 days at current drain rates. Physical silver markets across 3 separate continents are simultaneously registering multi-year inventory lows. Together, these developments are drawing a picture of an economy under pressure from multiple directions at once: labor, energy, inflation, and commodity supply chains. Turning now to a deeper look at the economic data. The February jobs report did not merely miss its target, it moved in the opposite direction entirely. Analysts had projected a net gain of 58,000 jobs. The actual figure came in at a loss of 92,000 positions. That gap represents a significant departure from forecasted conditions, not a marginal shortfall. Unemployment rose to 4.4% against an estimate of 4.3%. And while that difference may appear narrow in isolation, it takes on added weight when placed alongside wage data showing average hourly earnings still growing at 4% annually. When job losses and sticky wages occur together, the Federal Reserve faces a particularly constrained policy environment. Cutting interest rates risks feeding further inflation. Holding rates steady risks accelerating job losses. There is no straightforward exit from that position. Financial markets reflected that tension clearly. The S&P 500 dropped more than 1% on the session. The NASDAQ fell 1.5%. The small-cap Russell Index declined more than 2%. Notably, bond yields fell at the same time equities sold off, a pattern that, on weak jobs data, does not necessarily signal expectations of rate cuts ahead. Instead, it points to warnings about broader economic deterioration. Additional data reinforces that concern. Retail sales fell 0.2% in January, and consumer spending flatlined over the same period. Americans appear to have pulled back on purchases while prices continue rising. The soft landing narrative that Federal Reserve policymakers had referenced over the preceding 2 years is, by these measures, no longer supported by incoming data. On the energy front, the situation in the Middle East has moved well beyond background geopolitical risk. Brent crude broke $90 per barrel for the first time in 2 years. West Texas Intermediate is trading at $87. The Trump administration has stated that unconditional surrender is the only acceptable outcome in its posture toward Iran, with no negotiations and no ceasefire on the table. Qatar's energy minister has warned publicly that oil could reach $150 per barrel within 2 to 3 weeks if tanker traffic through the Strait of Hormuz cannot continue unobstructed. Natural gas prices could rise 400% under that scenario, and Qatar has stated that a continuation of the conflict for even a few more weeks would deliver a measurable hit to global GDP. Kuwait has begun cutting production and is now in discussions about limiting output to domestic consumption only. Approximately 2.6 million barrels per day of production is assessed to be at risk. Oil storage across the Gulf region is reported to be at capacity. Russia is supplying Iran with real-time intelligence on the locations of United States ships and aircraft. Iranian officials have stated that forthcoming attacks will be more intense and more widespread than previous ones. The inflation implications of rising oil prices are direct. Each $10 increase in oil prices adds roughly 20 basis points of additional inflation pressure. Oil has moved from the mid-50s to $87. That represents more than a full percentage point of additional inflation already built into the pipeline. At $100 per barrel, the consumer price index is projected to push past 3%, occurring simultaneously with rising unemployment. In the silver market, the physical supply picture has grown increasingly acute. Western spot silver is trading at $84. Shanghai spot silver is at $96, a $12 premium. The Shanghai Futures Exchange has seen its silver inventory fall 77% since October, dropping from 36 million ounces to 8.2 million. A single session this week saw 539,000 ounces leave those vaults. At that rate, the remaining inventory would be exhausted in 15 days. The Shanghai Gold Exchange tells a comparable story, with silver holdings down 64%, from 39 million ounces to 14.3 million. On the COMEX in the United States, registered silver is tracking toward depletion in 91 days at current drain rates, itself down 34% over the same period. 3 separate exchanges, across 3 separate continents, are all registering simultaneous drawdowns. The paper futures market is also showing notable stress. Silver backing COMEX futures contracts has been declining by approximately 20 million ounces every month for 6 consecutive months. COMEX silver open interest has fallen to a 12-year low, and trading volume has collapsed. In response, the CME Group cut silver futures margin requirements by 22% in a single move, lowering the cost of holding positions in a market where physical backing is simultaneously eroding. Gold open interest on the Shanghai Futures Exchange has also fallen to a 3-year low, with leveraged positions being unwound broadly. One regulatory development in particular has received limited coverage in Western financial media. India's securities regulator issued a formal circular, effective April 1st, requiring all mutual funds and exchange-traded funds holding physical gold or silver to discontinue using the LBMA London fixing price as their valuation benchmark. From that date, they must use the domestic spot price sourced from Indian exchanges. The regulator cited uniformity as the official reason. The move follows 2 separate instances, in October 2025 and again earlier this year, in which India's domestic silver prices decoupled significantly from London prices, because physical metal could not be delivered from London quickly enough to meet Indian demand. When arbitrage failed and prices diverged, India's regulator revised the rules to reflect actual physical market conditions rather than paper benchmark pricing. India is one of the world's largest silver consumers. To bring all of today's developments into focus, the February jobs report confirmed a loss of 92,000 positions against a forecast of a 58,000 gain, with unemployment rising to 4.4%, and wages remaining elevated at 4% growth. The combination places the Federal Reserve in a position where neither cutting nor holding rates offers a clean resolution. Retail sales fell in January, and consumer spending has flatlined, further undermining the soft landing outlook. In energy markets, Brent crude has broken above $90 per barrel for the first time in 2 years. Qatar's energy minister has warned of prices potentially reaching $150, with natural gas potentially rising 400% if the Strait of Hormuz is disrupted. Kuwait is discussing limiting output to domestic consumption. Approximately 2.6 million barrels per day of production is at risk. Each $10 move higher in oil carries roughly 20 basis points of additional inflation, and oil has already moved more than $30 from its recent range. In physical silver markets, the Shanghai Futures Exchange is 15 days from vault depletion at current drain rates. The Shanghai Gold Exchange is down 64% from its October inventory levels. COMEX registered silver is tracking 91 days to depletion. COMEX silver open interest is at a 12-year low. The CME has cut silver futures margin requirements by 22%, and India, one of the world's largest silver consumers, has formally instructed its funds to stop using LBMA London pricing as of April 1st, moving instead to domestic exchange pricing, a direct response to 2 prior instances where London-priced silver physically could not reach Indian markets fast enough to prevent price decoupling. Silver recovered from a low of $81.60 this morning to trade at $84 in the New York session, a gain of 3 to 4% on the day. Gold is trading at $5,149, having spiked on the morning jobs print, briefly retraced, and then pushed higher as the dollar softened. What today confirmed, across multiple asset classes simultaneously, is a set of structural pressures converging at the same moment. A labor market deteriorating while inflation remains elevated, an energy market facing acute supply risk from ongoing conflict, and a physical precious metals market draining across 3 continents with no visible inflows replacing what is being withdrawn. The paper futures market is contracting at the same time. India is formally restructuring how it prices physical metals away from the established London benchmark. These are the data points on the table as of today. The market will now process them. We will continue to monitor and report as conditions develop. For this broadcast, thank you for watching. Stay informed.